In the previous video on Follow My Rules or Lose Everything, I told you that a trader without emotional control is like a pilot flying blind through turbulence. Now let's take that a step further, because rules mean nothing if you don't understand the mental framework behind the market's movement. You can be the most disciplined person alive, but if your perception is clouded by fear or the need to be right, you'll never truly see what the market is communicating. You'll be standing in front of opportunity, but emotionally blind to it. And that, my friend, is how you get shaken out before clarity even arrives. Let's talk about the art of reading probabilities through structure. Not guessing, not hoping, not gambling, but interpreting behavior. Because the market always reflects collective belief. And if you can stay emotionally neutral, you'll hear that belief shifting long before the breakout becomes obvious. The crowd sees randomness. The trained trader sees psychological rhythm, the formation of energy, the intention of participants. Every high and low, every retracement is a mirror of collective emotion. And if you can observe it without judgment, you'll recognize when the market is preparing to shift its balance of power. Ask yourself this. How many times have you seen a market move sideways, thought it was going nowhere, then watched it explode right after you lost patience and walked away? That's not bad luck. That's your mind reacting to discomfort instead of staying in sync with what is. The market was whispering, "I'm building energy." You just couldn't stay neutral enough to hear it. A consolidation is psychological compression, energy building, shaking out the traders who can't emotionally handle uncertainty. I used to watch that process unfold for days, sometimes weeks. I didn't mind waiting. You see, trading isn't about constant activity. It's about alignment with high probability conditions. Most traders can't wait. They crave relief from uncertainty, so they act. But the professional waits until the market confirms collective agreement, when the imbalance between buyers and sellers becomes undeniable. Now, when I talk about structure, I'm not just talking about highs and lows. I'm talking about belief systems manifesting through price. When the market forms higher highs and higher lows, it's not just buyers in control. It's belief in higher prices becoming more accepted. When lower highs and lower lows appear, confidence shifts the other way. Simple, but not easy. Because simplicity terrifies the human mind that seeks control. Here's what I do. I mark out the key emotional pivot points where traders react, where they hesitate, where they defend. Then I wait. Because before every breakout, there's always a psychological test, a fake move, a shakeout, a trap designed to expose who's trading their plan and who's trading their fear. That test is where most lose, not because of lack of knowledge, but because they can't emotionally handle being uncertain. Tell me, how many times have you entered a trade right before it reversed? Of course you have. We all have. That's not the market punishing you. That's your mind revealing its attachment to outcome. A breakout isn't valid until the collective belief proves itself. The market has to demonstrate commitment. You want to see emotional conviction, volume, follow-through, flow. You want to see that the majority has finally accepted what you've already prepared for. That's when you move, not before. There's a funny thing about breakouts. They rarely unfold cleanly. The market, being a reflection of mass psychology, loves deception. You'll see a push above resistance, then a sharp drop. That's emotional bait. It lures in those seeking excitement instead of confirmation. But when the real breakout comes, it feels different. It feels inevitable. The structure, sentiment, and momentum align. You sense it, not through prediction, but through the absence of internal resistance. That's not luck. That's emotional alignment with the market's truth. And here's what's interesting. The patience to wait for that kind of clarity is directly tied to what we talked about in Follow My Rules or Lose Everything. Because your rules mean nothing if you can't stay emotionally balanced while following them. You might know where the structure will shift, but if you can't remain mentally still through false signals and boredom, you'll never experience the real move. I used to watch markets tick by for hours, not to act, but to observe, to sense when the market's behavior changed, when the rhythm shifted from uncertainty to conviction. That's the edge. Most traders miss it because they try to predict instead of allowing. Remember, prediction is ego. Observation is truth. Picture this. Price drops, makes a low, bounces, then tests that low again, but doesn't break it. That's not just buyers stepping in, it's belief in lower prices weakening. When the market takes out the recent high with strength, that's confirmation of a psychological shift. You don't have to chase it, just recognize it. And don't fool yourself into thinking every breakout means profit. Some are just expressions of random energy. Context matters. The larger the emotional buildup, the greater the potential release. A structure forming over weeks holds more psychological energy than one forming for hours. How many times have you jumped into a move only to watch it collapse? That wasn't the market failing. It was you reacting. The structure wasn't ready, but your emotions were impatient. The market rewards patience and punishes emotional urgency. A valid breakout shows alignment across perspectives. Higher time frames support the move. Volume confirms conviction. Sentiment shifts. You can feel it. That's when you prepare, not when you chase. Most traders crave certainty before acting. But the market doesn't deal in certainty, only probabilities. Your edge lies not in knowing, but in accepting not knowing while managing risk. And that's where real wealth is built. Not by catching every move, but by aligning with high probability moments and preserving capital the rest of the time. Capital is not just money. It's your ability to stay emotionally objective. The trader who protects his capital protects his mindset. The one who trades impulsively loses both. Every market speaks the same emotional language: accumulation, distribution, expansion, contraction. You just have to become fluent in it. So the next time you look at your chart, don't stare at the candles begging for certainty. Study the behavior, the emotional footprints of participants. The market breathes in tension, hesitation, aggression. Once you learn its emotional cadence, you'll see opportunity forming while others remain blind to it. Remember, confirmation outweighs prediction. Every trader wants to know what happens next, but that desire, that emotional need for control, is what destroys consistency. The market doesn't reward prediction. It rewards clarity. It rewards the observer who waits for proof rather than the dreamer who guesses. Guessing is gambling. Waiting for confirmation is alignment with probability. When I say confirmation, I don't mean someone else validating your decision. I mean the market showing its hand, clearly. Price never lies. Behavior never hides. When momentum sustains and levels flip from resistance to support, when participation increases and hesitation fades, that's confirmation. Think about how many times you've seen the perfect setup, only for it to break out briefly and then reverse. That's what happens when you act on anticipation instead of evidence. The market gave you a signal of potential, not commitment. Confirmation is waiting for commitment, for the market to demonstrate consensus. Ask yourself, why the rush to be first? The market doesn't pay for early entries. It pays for accurate execution. The impatient get trapped. The patient get paid. The professional doesn't need to be early. He just needs to be aligned. Real moves unfold with rhythm, not explosion. They confirm themselves through collective behavior. I learned this through pain, chasing every first breakout, convinced it was the one. But the market humbled me. The first move is often the test. The second, the confirmation. That's where the professionals enter, not with excitement, but with composure. Large players don't chase. They observe, confirm, and act without emotion. They don't need to be first, only right. That's the difference between a professional and a speculator. In trading, prediction feeds the ego. Confirmation builds consistency. The ego says, I called it. The professional says, I waited for it. Every chart tells a psychological story. Every breakout begins with hesitation. The impatient gets shaken out. The patient step in. The difference isn't knowledge, it's mindset. The beauty of confirmations that it transforms trading from a game of reaction into a practice of observation. You stop responding to every tick as if it's a threat or opportunity. You start seeing each movement as information, feedback from the collective state of mind. You're no longer trying to force the market to align with your expectations. Instead, you're aligning your perception with what the market is actually doing. When you do that, everything changes. You trade less, but each trade carries more psychological weight, more clarity, more purpose. You stop needing to be right on every trade. You begin to care only about being right when your edge appears, when the probabilities are finally in your favor. Remember, the market has two kinds of moves, emotional ones and structural ones. The emotional moves are built on impulse, fear, greed, and the illusion of control. The structural moves are built on collective agreement and momentum confirmation. The power of confirmation lies in its ability to filter the difference between noise and signal. A fake move collapses under emotional weight. No follow-through, no consistency. A real move breathes life. It sustains and expands because conviction supports it. When price breaks a meaningful level and holds above it while activity increases, that's life. That's belief being reinforced. That's your edge, where probability tilts in your favor. Do you know why most traders fail? Because they believe trading is a test of prediction instead of perception. They think success comes from forecasting turns instead of reading what is. But the truth is no one, not me, not you, not the biggest institutions, can predict where the market will go next. What professionals understand is how to respond when the market reveals its intent. They wait for evidence, for confirmation. They don't need to guess because they understand that every chart is a psychological mirror. When I used to watch the tape, I wasn't searching for certainty. I was watching for behavior, for how the market absorbed emotion around key levels. I didn't care what the news or crowd said. I cared what price behavior confirmed. If the market tested a level again and again, then finally broke through with strength, that was confirmation, proof that the belief structure had shifted. That's when I acted. I didn't need to be the first tick above resistance. I only needed to see that the collective mind had changed its conviction. And here's something most traders never internalize. Confirmation is protection. When you predict, you're emotionally exposed. You're trying to be right before the market proves anything. But when you wait for confirmation, you trade in harmony with what's already unfolding. You trade from alignment, not anticipation. Does that mean you'll never lose? Of course not. Confirmation doesn't promise perfection. It offers clarity. It filters noise from truth. It stacks probability, not guarantees. That's the essence of trading. Not certainty, but working consistently within uncertainty. When you merge confirmation with discipline, you transcend from reactive trader to consistent performer, and that transformation starts in your mindset. Waiting for confirmation requires self-trust, patience, and emotional neutrality. It forces you to sit still while others are scrambling, to watch chaos unfold without becoming part of it. It reminds you that this business isn't about excitement. It's about clarity through repetition. So the next time you see a breakout, don't rush to declare victory. Watch its behavior after the breakout. Does it hold above the level, or does it retreat? Does volume support conviction, or is it just noise? Does structure align across time frames, or is it isolated chaos? That's your confirmation. That's when professionals act, because the market always confirms before it commits. Structure is intention made visible. Price action is the language through which the market tells its truth. I learned this after years of staring at the tape, watching numbers and prices dance across the screen. The market never speaks in words, but it always tells the truth to the trader who's emotionally quiet enough to listen. Every movement, every candle, every tick carries a reason, a reflection of collective psychology. Once you understand structure, you start understanding that reason. Most traders miss it because they're looking for shortcuts, for signals that relieve their emotional discomfort. But the secret is already on the screen. It's in the rhythm of price itself. The market is alive. It breathes, it expands, it pauses, it reverses, all governed by the emotional states of its participants. Structure is how that emotion becomes visible. Ask yourself, why do you think the same patterns repeat across decades and markets? Because human behavior doesn't evolve as fast as technology. Fear and greed leave the same fingerprints now as they did a century ago. Structure is the emotional shadow of those forces. When you see higher highs forming, it's not just price rising, it's confidence manifesting. It's collective optimism overpowering doubt. When you see lower lows, it's not just selling pressure. It's capitulation, surrender, fear taking the wheel. A chart is a battlefield of belief. Each bar, each line is a record of conflict. Buyers and sellers asserting their conviction. When buyers push up and fail, that rejection becomes resistance. When sellers press down and fail, that bounce becomes support. Those zones, those emotional footprints, are where the truth lies. A professional trader reads those footprints like a detective reads clues. They don't need to predict what happens next. They need only to recognize what's already unfolding. The market isn't wrong. People's expectations are. Most traders interpret the market emotionally, wanting it to confirm their beliefs. But structure doesn't care what you believe. It reflects only what is. Once you detach from the need for control and accept that price reflects mass psychology, your entire relationship with the market changes. You stop fighting it. You start flowing with it. Think about how structure forms. First, accumulation, quiet preparation, smart money positioning while the crowd is asleep. Then markup, prices rising as awareness spreads. Then distribution, professionals exiting into late enthusiasm. And finally, markdown, prices falling as the crowd realizes too late. This cycle repeats endlessly across all instruments, all time frames. Recognize where you are in that structure, and you already hold the advantage. Ever notice how price revisits the same levels again and again? That's because markets have memory. Those zones are emotional scars, points of past pain or missed opportunity. When price returns, the same emotions return with it. Traders react, some flee, Others fight to redeem their past mistakes. These emotional reactions create predictable structures, reaction points, traps, shifts in control. That's why markets aren't random. If they were, patterns wouldn't exist. But they do: flags, triangles, ranges, trends, all evidence of organized psychology. Structure reveals rhythm, not chaos. An uptrend, higher highs and higher lows, is confidence expanding. A downtrend, lower highs and lower lows, is confidence collapsing. When structure fails to make a new high, momentum is shifting. Professionals notice before the crowd reacts. Price action is the real-time expression of belief. Indicators lag. They summarize what's already happened. But price reveals decisions forming right now. Consolidation is hesitation. Breakout is conviction. Every phase tells a story. Every transition offers opportunity. When I traded on the floor, I didn't need 20 screens or flashing algorithms. The tape was enough. Pure structure, in motion. You could feel the transition from uncertainty to conviction. That came from observation, not prediction. Once you truly understand structure, prediction becomes unnecessary. Patience replaces anticipation. Observation replaces fear. Structure reveals strength and weakness in behavior. When price breaks a high but collapses back below, it's emotional, not conviction. But when price breaks and holds, consolidating above, that's confidence. That's truth. Most traders miss it because they're chasing outcome instead of studying process. But structure is the one constant across markets, instruments, and eras. The psychology never changes, only the symbols, whether it's stocks, forex, commodities, or crypto. Structure is universal because human emotion is universal. What you see on a 1-minute chart also exists on a monthly one, just stretched across time. Once you train your eyes to see that pattern, any market becomes readable. And here's what structure teaches most of all: humility. Sometimes the structure is clear, other times it's chaos. That's the market's way of saying, wait. You don't have to force clarity where none exists. Waiting is an act of strength, not weakness. If a chart looks confusing, it's not your failure. It's the market writing a new story. The best trades come when the story finishes its chapter. When you see higher lows pressing against the ceiling, pressure is building. When that ceiling finally gives way with conviction, intention is revealed. Structure shows not just where to act, but where not to. It exposes traps, emotional zones, shifting value. That's why trading isn't guessing. It's recognizing evidence. Structure is the footprint of capital flow, the proof of belief. The market doesn't need to be predicted. It needs to be read. Every peak, every retracement, every sideways phase, all part of the same language. Learn to read it, and the noise disappears. The opinions fade. Only truth remains, the rhythm of price itself. Because when the market makes higher highs and higher lows, confidence rules. When it makes lower highs and lower lows, fear dominates. That's it. No complication, no magic. And yet simplicity is what most traders fear, because their minds crave complexity. But the market rewards clarity, not cleverness. Every higher high is proof of strength. Every higher low is proof of belief. That rhythm is the pulse of the market's psychology. You don't need an indicator to tell you what you can already see. Indicators follow price. Price follows belief. Watch the structure. That's where truth lives. When price makes a new high, then pulls back without breaking the prior low, that's confidence in motion. You don't need to predict the next candle. You only need to stay attuned to the rhythm of conviction. When I started out, I used to bury my charts under every indicator I could find. I was chasing precision, chasing certainty. But all that noise blinded me to the only thing that ever mattered. The flow of price, the unfolding of belief in real time. Once I stripped my charts bare and started observing pure structure, everything changed. The story became visible. I could feel when conviction built and when it dissolved. I could sense when control passed from buyers to sellers and back again. That's when I understood higher highs and higher lows aren't just visual patterns. They're the footprints of confidence, the visible trail of shifting psychology. Let's say the market's been trending up. You see it push into a new high, then pull back to form a higher low. That higher low is not random. It's where belief holds steady. It's where participants defend their perception of value. If price holds above the previous swing low, the structure remains intact, and confidence remains unbroken. When that higher low produces another higher high, that's confirmation. The collective belief is still leaning bullish. It's logical, it's mechanical, it's observable. You don't need opinions, you only need awareness. But what happens when the market fails to make a new high? What if that next push stalls, weakens, or reverses? That's the first whisper that control is slipping. The lack of follow-through signals that confidence is fading. When the next low comes in lower than the last, the sequence shifts, and with it, the emotional balance of the crowd. That's your early clue, not from an indicator, but from raw behavior. You're not reacting to a signal. You're reading a collective mindset in motion. This kind of observation takes patience and emotional control. Most traders don't want to wait for confirmation because uncertainty is uncomfortable. They want to predict, to act first, to prove they're right. But anticipation is the ego's trap. Professionals don't predict, they respond. They let the market define control and then align with it. That's what trading truly is, aligning with strength, not resisting it. Do you know why so many traders lose in strong trends? Because they fight them. They look at a clean series of higher highs and higher lows and think, it's gone too far. It must reverse soon. That's not logic. That's the ego trying to reclaim certainty. They step in front of momentum because being right feels more important than being profitable. But structure doesn't care about your feelings. As long as that sequence holds, belief remains intact. Trying to call a top before structure breaks isn't analysis. It's emotional gambling. This approach teaches you discipline. You don't buy because price went up once. That's impulse. You buy when price forms a higher high and a higher low. That's evidence. You're waiting for the market to prove its intent twice. That's not guessing. That's confirmation. You're allowing the market to validate your idea before committing capital. The same principle governs downtrends. Lower highs and lower lows reflect dominance of fear. Every rally in a downtrend is just temporary relief before belief collapses again. Seeing this clearly changes your psychology. You stop reacting emotionally. You start reading shifts in conviction calmly. In uptrends, you buy the controlled pauses, not the spikes. In downtrends, you sell the rebounds, not the plunges. That shift, from emotion to structure, from reaction to observation, is what separates a trader from a gambler. The real beauty of this principle is its universality. It works in every market, in every time frame. Whether it's a daily chart of an index or a 1-minute crypto pair, structure speaks the same psychological language. Zoom in or out. The rhythm doesn't change, only the time frame of belief does. That's why professionals adapt effortlessly. They don't memorize setups, they understand behavior. I remember the early days, watching the market grind higher, thinking it had to fall soon. But the structure never broke. Each dip was bought. Each retracement was shallower. That was confidence solidifying. That's what control looks like. And that's when I finally learned to stop guessing and start observing. Once you recognize control, your mindset changes completely. You stop trying to outsmart the market. You begin to flow with it. Ask yourself, are you trading with control or against it? If you can't answer that, you're not seeing structure. Control isn't hidden. It's revealed in every swing. Buyers and sellers are always leaving clues. You only need to see which side is making progress and which side is failing. When buyers push to new highs consistently, that's persistence. When sellers can't drive price below old lows, that's weakness. The chart tells you who's winning long before the headlines catch up. When you strip away the noise, all that remains is truth, structure. It doesn't need interpretation. It doesn't care about your opinions. It just reflects who's holding belief and who's losing it. Higher highs and higher lows, so simple. Yet that simplicity carries all the power. Because once you can see who's in control, you stop needing to be right. You just start aligning with reality. Consolidation is potential energy. Breakouts are the release of that energy. That's one of the truest lessons the market teaches. When price stops trending and begins moving sideways, it's not indecision, it's compression. It's the buildup before a new consensus. The market is a coiled spring. It contracts to store energy, to trap emotion, and when that energy releases, it explodes into direction. You've seen it. Price surges, then stalls, moving tightly in a range. Most traders get bored. They label it untradable, dead, slow. But that's the quiet before clarity. Each candle, each failed breakout, each rejection within that range is the market breathing in. The professional listens. They don't tune out. They study the buildup because consolidation always precedes expansion. It's nature's rhythm. Compression before expression. Ask yourself, how many times have you left a trade out of boredom, only to see it break out minutes later? That's not bad timing, that's emotional impatience. Professionals see consolidation not as wasted time, but as preparation time. That's when they map structure, define levels, and await for alignment. Because when the energy releases, it releases fast, and only those who prepared emotionally and structurally will catch it.